Hello friends, ADC here from the lowlands of East Scotland. Today is the 18th of October 2018. I've been asked to talk about cryptocurrencies, and I have been a little bit out of the loop ever since approximately May, so I apologize if I make any mistakes, but I'm going to try and cover the topic as thoroughly as I can in as little time as possible. I'll most definitely be needing a follow-up video to discuss other aspects which I think are important about cryptocurrencies. Now, the first thing that any viewer needs to know, if they don't know anything about cryptocurrencies, is that they rest on a foundational technology called blockchain. Now, blockchain, and link in the description for quite a good article that I found discussing it and explaining what it is essentially a method to connect pieces of information in a permanent way. So in the case of cryptocurrencies, which is arguably one of the first, or if not the first, implementation of the blockchain algorithm, it is transactions. So a transaction is made, and then the next transaction in the block is connected essentially permanently, because it is once the transaction is made, it is put on a ledger which is distributed to the whole network which is participating in the creation of this ledger. So, and nothing can be changed retroactively, because you would have to change it on everyone else's PC, which is impractical, shall we say, at the least. So the foundational technology blockchain is this public ledger. So there's also the advantage that it is transparent, that is permanent, and is at least it should be secure, because it is based on these very complicated algorithms. Now, blockchain has a lot of how would we say applications, and the article that I link from, I believe it's called blockgeeks.com, does mention a lot of these applications, including, and the one that I'm most fond of, especially because I know there's one viewer that invests in Cardano. Cardano is another cryptocurrency other than Bitcoin that uses the Ethereum network, and I'll explain what that means. So the Ethereum network uses a proof of stake algorithm rather than a proof of work, and I'll explain what that is in a second. But so Cardano has recently signed an agreement with the Ethiopian government for something to do with Agritech, and they're going to be using their kind of blockchain and their cryptocurrency for affairs. I'll link an article in the description, but I don't want to discuss it too much. So essentially, the point is that blockchain can be used in a bunch of different ways, and it's the resting technology in which cryptocurrencies sort of function. But now I want to talk about specifically cryptocurrencies and what I think of them. Let's talk about this article that I found from a certain Brosens, I believe his name is, from Inch Bank. Of course, Inch Bank has possibly some conflicts of interest talking about Bitcoin, because essentially it is a threat to the traditional banking system. But I think that I found that the points that are made in the article are quite accurate, in the sense that it points out that the transaction cost of Bitcoin is very, very high in comparison to other methods of doing transactions. So, to the average transaction for Bitcoin, so if I'm transferring money from Alice to Bob, it would cost me approximately 220 kilowatt hours. To put that in perspective, as the article notes, it's about 200 wash cycles for your washing machine. Washing machine, not a cheap electrodomestic. So if I'm going to buy some pizza for, say, 10, 15 pounds, euros, dollars, then if I'm going to be paying the equivalent of 200 kilowatt hours, which, I don't know, approximately 2 or 3 pence per kilowatt hour, is whatever, a couple pounds in transaction cost, then effectively that discourages me from doing any small transaction. Possibly wouldn't discourage me from making a huge transaction, but why would you have the equivalent of $10,000 or pounds in Bitcoin just lying around? And why would it be so crucial for you to use specifically the Bitcoin network, is my question. Network, of course, which in theory is anonymous because these transactions are done between two sort of hash numbers, but you could start triangulating data, especially because the ledger is public. And you could, if someone wants to find you, if a government wants to find who is doing what transaction, they will find you. At least that's, to my understanding, how it works. So since the transaction cost is so high, then I don't particularly see, and that is also one of the reasons why I haven't been into the loop recently, at least 6 months, especially after the crash of January. If the transaction cost is so high, I don't see why the currency will survive any longer, which is exactly the problem that Ethereum is trying to solve. And in the article, it does note that the transaction cost for Ethereum on the Ethereum network is approximately 66. I'm quoting the numbers off the top of my head, but in any case, it is lower than the Bitcoin network because they work, instead of functioning with the proof of work algorithm, which essentially requires a lot of computing power, and that's why they're called miners, Bitcoin miners. Essentially the verification process of the blockchain requires a lot of computing power. You have to throw the algorithm problem that has to be solved is so complex that there is no method, a numerical method like, say, Newton-Raphson, to converge to the answer. The best method would be just to throw random numbers at it until it is solved. Just kind of trying all the keys until the lock is unlocked, sort of metaphor. So that's the proof of work algorithm, and if all computers are trying to solve that specific transaction, the first one that solves it sort of verifies that it's not fraudulent and makes the transaction sort of valid, makes it happen, and adds it to the blockchain and so to the ledger of transactions. But the proof of stake algorithm essentially puts part of your money into escrow. Essentially puts it in a state where you can't access it but no one else can, and it's kind of safe. And then once if the transaction is verified as non-fraudulent, then you get your money back, and the transaction goes through. But if it is found as fraudulent, then I'm not sure what happens to the money. I guess it gets absorbed by the network or disappears or something like that. So it has its advantages, namely that it costs less electricity. But it forms a plutocracy, as the article puts it, and it is the apt term. Essentially, it creates an incentive for, well, the money rules, plutocracy. So the people who have the most money on the network essentially control the transactions and could, in theory, game the ledger, just as a Bitcoin or a proof of work algorithm could be gamed essentially by outspending the rest of the network by having so much computer graphics power to compute your own transactions. But that it's extremely unlikely that you can do that, and it's the same with plutocracy, although possibly less unlikely. But still, compared to Visa, which manages your day-to-day transactions with your bank card, the cost in kilowatt hours is 0.01, so it's thousands of times less than the average, if not almost 1 million times less than the Bitcoin or the Ethereum. Of course, the cost is other things. They have a central authority with people that have to work for in their offices, etc., etc. So that's one of the things that I think Bitcoin has a limitation, and cryptocurrencies in general have this limitation for now, that the costs are too high, and I don't see them being used in a real economy. I seem to recall many years ago, and it's one of the reasons why I didn't invest in Bitcoin back then, although maybe I should have, since the prices did skyrocket after that. And one of the reasons is because there's no real economy behind it. The majority of transactions are trade transactions between people who are just buying and selling on their day trading, and without any real economy behind it. So that I think that's a point against Bitcoin and cryptocurrencies in general. Cryptocurrencies that I just checked on CoinMarketCap, link in the description, there are approximately 2,099. Last time I checked, there was only 1,600. So I expect to see a lot of these fail on the long term, especially if there is nothing to back up whatever their economy is doing. Cardano seems to be okay. I mean, if a government has signed sort of an agreement to use Cardano, then I think the survivability of that currency will be relatively high, unless it is going to be an epic failure. Yeah, and just like in the .com bubble and crash, we are currently in a Bitcoin, or well, cryptocurrency bubble. And even though we've had a crash in monetary terms already back in January, in fact this is the third one, and I'll probably discuss all the crashes since 2013. Well, the first one was 2013, I believe. There will be more, and I will be expecting to see more cryptocurrency deaths, just like BitConnect, which was the scam. BitConnect was this currency that it was essentially a pyramid scheme that encouraged people to buy and to raise the price, and then the BitConnect people who were in there early sold, and the whole thing crashed. And I'll leave a link in the description for that article. This was a few months ago. Yeah, so these are a few sort of initial opinions. I tried to keep the video as short as possible, and I'll see you next time. Leave any comments below for any other things you would like me to cover, or any follow-up information, or if I got something wrong. And that's it. Keep yourself, people.